Most people think financial systems are designed to be stable. They imagine balance, neutrality, a machine that just sits there and processes money fairly. But that's not what actually happens. Over time, almost every financial system develops a quiet tilt. Not overnight, not by conspiracy, but slowly, predictably, it drifts upward, toward larger players, toward those who already have capital, toward those who can wait longer, borrow cheaper, and absorb mistakes. And the strange part is this: the system can look perfectly healthy while it's doing it. Let's start somewhere uncomfortable. If you freeze the world today and ask, who does the system favor? The answer isn't effort, intelligence, or even risk-taking. The scale. Size bends outcomes. And it does so gradually enough that most people never notice it happening. That's what this video is about. Not crashes, not scandals, but drift. Because drift doesn't feel violent. Feels normal. And that's why it matters right now. For decades, we've been told a simple story. Markets are efficient. Competition keeps things fair. If something becomes too powerful, it gets disrupted. But look around. Markets are more concentrated than they were 20 years ago. The largest firms control more share. Capital pools are bigger. And financial shocks hurt unevenly. This isn't a coincidence. It's a structural outcome. To understand it, we have to strip the system down to its simplest mechanics. Imagine a financial system as a river. Money flows through it. Some people stand near the top. Some near the bottom. Everyone is technically in the same river. But the current isn't uniform. At the top, the water moves slowly and predictably. At the bottom, it's fast, chaotic, and unforgiving. That difference alone changes everything. Let's talk about borrowing. A small borrower pays more for money. A large borrower pays less. Not because lenders are evil. Because risk looks different at scale. If a massive institution fails, it can restructure, refinance, or get support. If a small one fails, it's gone. So interest rates quietly reward size. Over time, cheaper money compounds. Not dramatically, just enough. A fraction of a percent here. A little more leverage there. But compounding doesn't care about drama. It only cares about time. Now layer on time horizons. Large players can wait. They can hold assets through downturns. They can delay selling. They can absorb years of underperformance. Smaller players can't. They need liquidity. They need income. They need results on a shorter clock. So the same market event produces different outcomes. A downturn becomes a buying opportunity for some, and an exit for others. Again, no villain required. Just math. Then there's information. Not insider secrets. Just access. Big institutions don't necessarily know more. They just know sooner. They have teams, models, data pipelines. They don't need certainty. They need milliseconds and probability. That edge is tiny. But repeat it millions of times, and it stops being tiny. This is how drift forms. Not from one unfair rule, but from many neutral rules interacting. Each one defensible on its own. Together, directional. Now let's introduce something more subtle. Risk. We talk about risk as if it's evenly distributed. It isn't. For smaller players, risk is existential. One mistake can end the game. For larger players, risk is modular. Losses are absorbed, isolated, restructured. This changes behavior. When risk is survivable, you can take more of it. When risk is fatal, you can't. So paradoxically, the players who can afford to lose are the ones who get rewarded for taking risk. And markets celebrate risk-taking. They price it in. They reward it. But they don't reward vulnerability. Now let's zoom out. As systems mature, they don't reset. They accumulate. Past advantages don't disappear. They layer. Capital builds on capital. Networks build on networks. Credibility builds on credibility. The system remembers. And memory creates gravity. Once you reach a certain size, the system doesn't just reward you. Protects you. Not explicitly. Structurally. Rules get written with edge cases in mind. Liquidity facilities get designed for systemic importance. Stability becomes a priority, and stability sounds good, until you realize stability means preserving the existing structure. Here's the irony. Financial systems are built to manage risk, but over time, they become better at protecting incumbents than preventing concentration. Not by intent, by evolution. Each crisis accelerates this. After a shock, the weakest players disappear. The strongest absorb them. The system recovers. But it recovers at a higher level of concentration. Then comes the next shock. Same process. Same outcome. Upward drift. Now let's talk about the hype. We're told technology democratizes finance. That access equals fairness. That apps, platforms, and automation level the field. And in some ways, they do. Access improves. Friction drops. Participation rises. But access doesn't change structure. If anything, it increases velocity, which benefits those who already move efficiently. The tools are neutral. The starting positions are not. So you get the illusion of equality inside an unequal system. And that illusion is powerful. Because when outcomes diverge, people blame themselves. They assume they misunderstood the rules. But the rules were working exactly as designed. Just not for everyone. Now here's the uncomfortable math. If a system rewards scale even slightly and runs long enough, it will concentrate, not because people want it to, because the incentives push that way. And once concentration reaches a certain point, it feeds itself. More capital means more resilience. More resilience means more opportunity. More opportunity means more capital. A loop. Breaking that loop requires friction, regulation, redistribution, structural resets. But friction is unpopular. It slows growth. It reduces efficiency. It feels like interference. So systems drift instead, quietly, relentlessly, until the gap becomes visible enough to cause backlash. History is full of this pattern. Not collapse first, distortion first, then instability. And then people ask how it happened so slowly. Here's the part most explanations skip. Upward drift doesn't mean the system is broken. It means the system is working under its own incentives. That's harder to confront. Because fixing a broken system is easy to justify. Changing a functioning one is not. Especially when it still delivers growth, innovation, and progress just unevenly. So where does that leave us? It means fairness doesn't naturally emerge from markets over time. It has to be actively maintained. It means neutrality isn't neutral if starting points differ. And it means stability can hide imbalance. The financial system doesn't need to collapse to fail people. It only needs to drift far enough that participation stops translating into mobility. And that's the question worth sitting with. At what point does a system that works stop working for most people? And how would we even recognize that moment? If the drift feels normal, every step of the way,